organization. We can start by defining what is a wage and what is a salary. When we talk of a wage, we are talking of payment or compensation to an employee on a short-term basis like weekly, daily, and others. So like when you pay these people whom we call them the watu wa kibarua, those whatever they are paid at the end of the day or whatever they are paid at the end of a certain period of time, that is what we refer to as wage. For a salary, it is paid over a longer period of time. Like for example, when we talk of monthly pay, um, maybe quarterly pay, yearly pay, that's when we talk of wages. So, sorry, that's when we talk of salaries. And for this particular salary, it must be set in a way that it is the workers are compensated for the services they have provided in an organization, because when you set a wage or when you set a salary, you are setting it in order to satisfy or to compensate that particular person who has provided services to you. You don't buy the person, but you buy the labor services that that particular person has provided you with. And that's you, if you remember well in economics, I remember saying that when we are looking at factors affecting factors of production, I remember saying that the laborer usually sells his or her labor, but not him or herself. So when the organization is paying someone salary or wages, they are compensating him or her for the labor services they have provided, and therefore the wages and the salaries paid to an employee should be fair to that particular person. And I've said it must not be satisfying, or you must not be satisfied with whatever you're paid, but you should be contented with whatever you've been paid. Um, that is it, because as even if I give you a salary of 10 million today, I know tomorrow you still need more salary to be increased to you. And being good students of economics, you understand that, because there's more, the more the money that you're getting, the marginal propensity to consume usually increases with increase with income. You remember we talked of that. So that is when we talk of the definition of salaries and wages. And we can also ask ourselves, how are wages set? Number one, wages can be set based on the number of hours a person has worked, and that's when you'll be talking of time hourly rate. Like for people who work in the kibarua, like I had given the example earlier on, those people will be paid for labor services that they have, for labor services that they have provided for a certain given range of time. Like for example, you can be paying someone based on the hours, so meaning that the more the hours they have worked for you, the more the salary they will get from you. The less the time, the rest the salary. That's when talk of the hourly rate. Then after that, it disadvantages, and I've provided them in the one of it being that you'll be able to compensate for the advantages that you are compensating someone for the actual hours that that particular person has worked, or you'll be able to monitor what a particular person is able to work after for a particular given time. Then another type of salary payment is what we usually refer to as piece rate salary or payment. When you talk of piece rate payment, this is a payment whereby um, the workers are paid based on the number of items that they have produced, or what we talk of the output. Like for example, the number of units that you've produced. Like for example, if you are in a manufacturing company or organization, and you usually manufacture things like Colgate, you manufacture things like let's say talk of seats. Let me talk of carpentry. That's a good example, whereby someone can be paid based on a piece later. Um, if you make a furniture, you'll be paid by the number of furniture that you've made and the ones that they have been sold in the market. So that's when we talk of the piece later, whereby a person is paid based on the output or whatever he or she has produced. We have another one, which we call the normal working hour plus the bonus rate or bonus scheme. So what usually happens with this particular payment plan is that after working for agreed time, the normal time, like for example, for many organizations, the normal working times for usually 8 hours. Sometimes workers may give extra time, and this extra time, like let's say a worker was supposed to work for 8 hours, and this worker worked for uh, let's say 12 hours. So this particular person has worked for 4 extra time or 4 extra hours. The first 8 hours he will be paid normally. If the payment is like 100 shillings per hour, that is an agreement they have there is a set agreement for which a person can work normally. Then for the extra 4 hours, they will also be paid, maybe in most cases, a higher rate compared to the normal one, that is the 8 hours. So that's when we talk of the plus bonus pay. That's the extra time is what we are referring to as the bonus payment. So all overtime payment, because you've been paid for the time that you've worked over or above the time that you've agreed with your employer. So those are some of the ways that we usually determine the salaries of the workers, and just like that. So then I remember talking of now something that is very important, making sure that workers are paid be given that they have worked. And I know you've ever heard of some people whom we usually refer to as ghost workers. At times, the organization usually employ people, they usually pay salary for people who have not worked, and this is illegal, not legally. Some people usually pay people maybe based on the fact that they want to defraud the organization. So that's when you talk of ghost workers. A ghost worker is a worker who has not worked but is receiving the payments, is receiving the remuneration. This particular person is also receiving other forms of advances from the organization. So when such payments is made or it's given to someone, that's when you talk of ghost payments. So let's look at ways of preventing an organization from paying salaries, ghost salaries, or salaries to ghost workers. What can organization do to avoid the payment of salary to ghost workers? You remember I've talked of, when we talk of ghost workers, we're talking of people who are not supposed to be paid, or people who do not really exist but they are in the payroll of an organization. One of the way of avoiding payment of salaries to ghost workers is that ensuring that when salary is being paid, the clock in card and clock out card is compared, or it is being used. A clock in card is a card whereby people sign in when they are getting into an organization, or when they are reporting to an organization. Like in a no in a, at a, maybe at the point of entry, there is somewhere where employees usually sign in to record that they have entered, they have logged into the organization, and then when they are leaving the organization, they will still sign out. So when you maybe compare the times, maybe someone logged in at 10 and he had logged and he logged out maybe at let's say 8 p.m. at the night. So you can compare the difference between the two times, and you'll be able to know how much time did this particular person really worked, and from that you'll be able to pay salaries to those who really deserve. Another way of which by which you can avoid the payment of ghost salary is where you ensure that the salary, the payroll preparation cannot be under a single person. And what do we mean by that particularly? For example, it is only one person in the organization who prepares the payroll. It means that at a given point, this particular person can be and come up with fictitious ways through which he will be paying salaries to people who are not there. But if the process has several number of people, or has quite a number of individuals who are involved, the chances of someone being compromised are very low, compared to a time whereby it is only one person who is doing the process alone. So you can have several people involved in the process of preparation of the payload. The other one is peer review. When you talk of peer review, this is where when the payload has been prepared, an organization or someone maybe maybe in the same office can review whatever has been prepared, and so as to check whether it is the expected salaries or whatever, or it is what the organization maybe had expected to pay, or if more, you have to ask the person who prepared or the people involved in the preparation why they did so. The other thing that can help to avoid the payment of salaries to ghost workers, or payment of salaries to people who have not really worked in the organization, is that ensuring that when the employees are receiving their salary, they countersign against their names, or upon receipts of the salaries. Yes, that also helps in ensuring that individuals or people are not paid the ghost salaries, whereby if someone is signing against his or her name, that is a sign that that particular person is the one who really received the money or the salary. Doesn't we talk of countersigning against the individual's name. Another thing that can be used to avoid the payment of ghost salaries is that comparing the budgeted salaries with the actual salaries that have been paid. Yeah, before an organization starts operations, it usually comes with what we refer to as budgets. And this budget usually includes estimated maybe spendings and incomes of an organization, and therefore, and one of the spendings on one of the expenditure of an organization is a salary. And so the organization will be doing, they will be coming up with a way through which they will be comparing the two. Like, for example, they will say we had hoped that we'll pay workers 100,000, but we've paid them 120. So that one will raise a question: why have you paid more than we had expected? So that one will be able to raise a red flag, so as to avoid someone paying what we call the ghost salary. The other one is that keep on checking the workers' records. Yes, if for every organization there is the human resource department that keeps the workers' records, that keep maybe the number of workers who are there and their actual names. So what usually happens when an organization keeps on checking whether you say that you've paid 50 workers in the list, in the HR list, are we having 50 workers or we are having less? So that one, it's also another way of avoiding payment of ghost salaries by counter checking the list that is there, and uh, the hotel, the people who have really received the salary. That's when you talk of comparing the estimates, comparing the risk that the HR has for workers, and um, the number of maybe employees who have been paid salaries or who have been compensated to salaries. So those are some of the ways that an organization can prevent payment of salaries to ghost workers. Um, let's look at now composition of a person's salary or income. Let's look at a composition of someone's income. When you usually negotiate for a person's salary, there is a part of salary that is usually static, and that's what we usually refer to it as you remember, maybe you've ever heard of something called basic salary. So when you talk of a basic salary, this is the basic pay that an employee is expected to receive. Like, for example, an organization will say, we will be paying you 50,000 monthly. That is the basic that they have offered to pay you. Above the basic salaries, they may agree that they'll be paying extra money for the services that you have provided in for that particular organization. This extra payment or extra pay is what we refer to as, at times we usually refer to them as bonuses, and at times, in most cases, they are like allowances. So at times, based maybe on the kind of pay, it could be in form of a bonus or it could be in form of a allowance. Like, for example, you can be given what we call commuter allowance, you can be given transport allowance, you can be given maybe medical allowance, you can be given risk allowance, plus many other allowances that can be given to employees. This one, when you now take the the basic salary, you say that this is what is static, the whatever we pay this particular employee. So when you talk of the basic salary, we are talking of we are talking of that particular standing salary, the real salary that that employee is given without the allowances. Then when you now add to the basic the allowances or other bonuses, you get total salary, which we refer to as now salary. Now, note now the terms that I've used the word basic. I've used the basic salary, the term basic salary, and I've said the basic salary. This is now the salary without other payments. Then we've talked of other payments like allowances, bonuses. When we talk of them, those ones is what we'll be talking of. When you talk of basic salary plus the other payments that one receives, is what we refer to as the gross salary. Now, the worker does not take the gross salary because there are some deductions in his or her salary before he or she receives the actual cash. Like for example, when you hear of someone maybe employed to receive for let's say 30,000, 50,000, 80,000, that is not what they take home. That could be the gross salary that that particular person has agreed between him and the employer. But whatever he or she takes home, it's subject to gross salary assumptions. I want us now to look at this deduction because, as I've said, the gross salary will be deducted some deductions so that we get what we talk of take home salary or what we refer to as net salary. These deductions can be classified into two categories. The first category of this basic salary is called the first category of this basic salary is called what we refer to as the statutory or involuntary. When talk of statutory deduction or involuntary deduction, these are deductions that you have to be deducted, whether you like it or not, whether you prefer it or not. For statutory deductions, it is a must for them to be subtracted from a person's salary. That is something that you should note. Number two, we have what we call voluntary. Voluntary. Just like the word voluntary says, they are deductions made at a person's will, based on a person's will, based on what a person prefers. Those ones we refer to them as voluntary deductions. When you talk of voluntary deductions, remember we said that these are deductions at the will of the worker. Now look at them one by one. We shall start with what we call statutory or involuntary deductions. Statutory or involuntary deductions. We start when you talk of statutory deductions, we are talking of deductions that are made with it's a must for them to be deducted from us from a worker salary, and a worker has no choice to say no for the deductions. There are four categories in this case, and I would like all of you to put to note these particular deductions, because in most papers that I've seen for office organization, I've seen the examiner asking or setting questions from this particular area. So when you talk of statutory, I repeat, these are deductions that are made whether the employee like it or not. It is a must for them to be deducted from a person's salary. In Kenya, we have four, which it's a must for them to, whenever if a worker is in that particular category, it is a must that they will be deducted from his or her salary. Number one is what we call the pay as you earn. Maybe you have seen this particular word that I've typed. You've ever seen this particular word, the one that the public chat, PE or pay you earn. This PAYE, the one that I've typed in the public chat. So when you talk over PA, we are talking of tax tax deducted from a person's salary. Tax deducted from a person's salary. It is a must. Before you get your salary, the government must get its share first. Before your salary gets to the bank. It is not, you don't have an option whether you will comment. That one is usually already decided that you will the government will take your salary, or the employer will deduct from your salary a, a tax which will be submitted to the government in form of pay as you earn. That is one of the statutory deduction that we have. Number two, it is what we call the health insurance. Health insurance. For example, in Kenya, you've ever heard of National Hospital Insurance Fund, or what we call NH, NHIF. NHIF. That's what we talk of, National Insurance Hospital Fund. For NHIF in Kenya, it is a must for any employee, whether under the government, whether under the private sector. For them, they must pay that particular insurance, and they don't have a choice. It is a must that that particular payment must be deducted from their salaries, uh, and be submitted to the that insurance fund. As we talk about it. Another payment is contribution to social security. In Kenya, I know you've ever heard of the term NSSF. This is what we call National Social Security Fund, NSSF. In Kenya, it is a must for everybody pay or to contribute to NSSF as long as they have been employed. An NSSF is a fund whereby both the employer, unlike now the first two, whereby it is only the employee who contributes or who is deducted that amount. For the third one, that is NSSF, the employer and the employee contribute an equal amount towards the retirement of the employee. And in Kenya, for the basic amount is usually 200. So when you deduct an employee 200, the employer will also contribute the same 200. So meaning that whatever they send to the NSSF will be equivalent to 400 shillings. And this one is to take care of employees' retirement. This is for taking care of employees' retirement. That is it. We then we have the last one. This is now the levy. Or may deduct some levies from the employees. Like for example, when the Jubilee government took over its administration for the second time in 2017, they came up with what we currently refer to as the Big Four agendas. In these Big Four agendas, there was an agenda on housing. And to enhance this agenda on housing, the people were to be deducted. I'm saying were to be because it did not materialize, because there were the labor unions, the union that brings together the Confederation of Employers. They went to court and they prevented that. The government had proposed that for every employee, they must be deducted 5% of their salaries, and the employer would be deducted the same amount, and then in form of a levy, in form of a housing levy. And for this levy, for those who are who didn't have housing, they would be required to maybe to maybe to ballot for some houses. At the end of the time, they'll get some houses. Whereas if for those who did not need the houses, they will be given back their money after some period of time together with some interest. And that's when we talk of the housing levy. So those are what we call statutory deduction or involuntary deduction. Let me repeat them again because I've said this is a very fertile ground for the exam. The first one is the National Social Security Fund, what we call the NSSF, the Social Security. Number two, we talked of the medical insurance, and I gave a good example of NHIF, National Hospital Insurance Fund. I also gave an example of pay as you earn, that is pay-in. I also gave an example of levies. A good example is the housing levy. That's when we talk of the statutory or involuntary deduction. Let's now look at another deduction that is made on an employee salary. That it's what we call voluntary deduction. Voluntary deduction. For voluntary deduction, just like the word says, it is out of the will of the employee. It is not a must. The deduction is not made out of compulsion. Like with the first one, if you don't deduct those particular deductions, and it will be you can be taken to court because you've not complied with the law. So, but for these other ones, you are doing maybe based on your personal this data because you vary from one individual to the other. And this deduction usually starts with one, the loan deduction. At times, people usually get financial institutions like banks, circles. For those who want to get higher education, you know of help. So those loans are made out of individuals' choice, and no one compels someone to get those particular loan, and therefore the person who has taken a loan either with the bank or with any institution, they will be paying what you call installment payments. They'll be making what you call installment payments. For these installments that they'll be paying, and individuals will based will the individuals will be paying them based with the agreement with the lender or with the individual with the organization that gave them money. So that's when it comes voluntary. It is not a must. It's not out of compulsion. It is out of the will of this particular individual. Another deduction is the welfare, members' welfare contribution. In some organizations, they have established what we call employees' welfare. Maybe uh, this is a contribution that takes care of maybe when a worker maybe is diseased or dies, when he's providing his labor services, or when he or she is sick, when he is in employment, they will be paid. The workers will have a common fund to take care of those things. Maybe when a close relative leaves them, then there is that contribution which can be given to those particular workers. So, and maybe for them to have a fund or some money that is brought together, there is usually what we call the welfare contribution. So that one, well, a worker can say, I don't want to be a member of a welfare. So they will not be forced. So that deduction would be a voluntary deduction. Another deduction that is voluntary or out of the choice of an employee is labor union contribution. And this one is labor union and other association. Let's define it to labor union and other as country. Never heard of labor unions like NAT, KUPPET, and MASU for lecturers and others. Uh, for, for people to be members or to be included in this particular movement, they must be paying some what you call contributions or monthly contribution or periodical contributions to these particular organizations, and these one are done based on individuals' choice. It is you cannot be compelled to be a member of a certain union. You cannot be compelled to be a member of a certain professional bodies, because there are some professional bodies like for medics or for doctors. There is what we call KMPDU. That is a body that brings together all the doctors, the dentists, the pharmacists together. So when they bring them, when a person contributes or ascribes to this particular organization, the payments that is usually charged, it's out of the employee's choice or the member's choice. So it doesn't talk of it is a voluntary deduction. We have other professional bodies like ISPAC for accountants. It is out of individual's choice for him or her to join this particular body. So that's when we talk of that. Then another another voluntary deduction that is made for employee is what we call maybe the personal insurance cover. Sometimes individuals usually they have personal engagement with an insurance company, and from this particular maybe engagement, they will have a personal cover, maybe for life, maybe and or other maybe uh, things that may happen maybe in future. So when which maybe what we call in insurance term, that is uncertainties. Like you can insure yourself against maybe being fired, maybe after retirement you want to get some what you call some continue getting some payments. You want maybe if your work is risking, you can insure yourself against maybe they just uh, associated with your work. So when and all those particular maybe deductions will be made from your salary. So that such a deduction is called a voluntary deduction. It is because it is made out of an individual's choice. It's not you are not compelled by anybody to make those particular deductions. We have several depending on individuals, but those are the main types. So as I have insisted, this is a very fertile ground for the for examination. Please remember to lead and pay a lot of attention in that particular area. So that's when you talk of the deductions and all that one. Let's now look at what we call the terms and conditions for employment. The terms and condition for employment. So when you talk of any employment, there is an agreement, and we usually say that employment is a contractual engagement between the employer and the employee. For you to work in a certain organization, you must have an agreement with the person who has employed you on some issues, maybe in terms of salaries, in terms of how you'll be working, relating with each other, and all these conditions that you agree with are called the terms and conditions of employment, whether they are verbal or written. I know maybe some of you have employed people in your homes, or and before they are employed either as house help, maybe house managers, or whoever you have employed, maybe in the office or anywhere. You usually sit down with them and tell them, in my house, these are the rules and regulations. This is how I will expect you to behave. This is how I'll expect you to do the following things. And after you've agreed with those terms, or and each and every one of you will agree or will have maybe to decline. So those are the what we are referring to as the terms and conditions of employment. So they usually describe the relationship between the employer and the employee. So these terms of employment usually describe the relationship between the employer and the employer. So that's when you talk of the terms of employment. So there are some things that are usually captured in the terms and conditions of employment. Number one is job descriptions. In the terms and conditions of employment, they will explain what will be your work. What will you be expected to do in that particular organization? That's when we'll be talking of the job descriptions. Number two, we'll be talking of what kind of contract have you entered into. As you know, there are various types of employment contracts that are there in an organization. One of the types of employment contract is what we refer to as a permanent, maybe employment, permanent and maybe pensionable employment contract. This is where a person is employed by an organization from the time he or she enters the contract till when he or she maybe retires, or when either of the party terminates the contract. You are employed for a fixed period of time, not a longer period of time, maybe till retirement. That's when you talk of permanent and pensionable contract. The other one is you can talk of part-time. This is when you are employed for just maybe few hours, few days. Like you can maybe employ you to become to me, maybe to doing something to me for only 1 week or only 1 day in a week. That is a part time. Or for only 1 hour in a week, in a day. That's a part time. Then you also have what you call maybe short-term contract. And when you talk of short-term contract, this is when you have maybe been employed by someone for only 1 month. You've been employed by that particular person for 2 days, for not 2 months, a year. That's when you talk of the contractual arrangement. That's when you talk of it in terms of that. An important thing that will be found in employment, in the terms of terms and conditions of employment, it is the salary. And here This is where the employer will state all the types of remuneration that the employee is expected to receive in the course of the employment period. And here, maybe they usually quote both the basic salary and the allowances or the other allowances. Doesn't talk of the salary. Then they will also look at the deductions. These particular terms of and conditions of employment usually dictate what kind of deductions will be made with from your salary, because no deductions can made whatsoever without the prior notification to the individual, including the statutory ones. You will be first of all notified that we usually pay our salaries less statutory deductions. If you agree with it, you say. If you don't sign the contract. The other thing is the place of work. You agree with the employer. Where will be attached at? What will be your working place? Where will be your working center? So doesn't talk of the place of work. Where will you be located? Doesn't talk of the place of work. The other one is the leave days. Where in the employment contract, that's what we call leave days. Sometimes employees need some time off from work, maybe it's to go and take care of um personal maybe affairs. So when that one happens, they will be given maybe a day off, or what we call maybe a leave. In some contracts, they will give you maybe a 1 year leave whereby it's paid leave. Some people will give you an unpaid leave. That one will be explained in the terms and conditions of employment. The other thing is expenses. Sometimes employees usually incur expenses in the performance of their duties. Things like we can talk of things like transportation cost. Maybe sometimes you're working from a far area, from maybe the place of work you've been given to a far area, like you are a marketing guy, and you've been sent maybe to Kisumu to go and market your organization, and you've come from Nairobi. You like maybe incur some expenses like accommodation and others. So in some case, in that terms and condition, they will agree that after you've incurred such expenses, who will be paying for them? Is it you? Is it the employer? That one will be talking of that. The other thing is confidentiality. Given a worker is an employee of an organization, they are likely to maybe to know much details or more details about the employer, and therefore they usually sign a confidentiality contract or agreement with the employer, such that agreeing that they will not disclose anything about the employer without the consent of the employer. Doesn't talk of the confidentiality. Sometimes it's what we call non-competing. Sometimes in some organization they require their employer to sign an agreement on non-competing, meaning that an employee will not start a venture closer or similar to what the employer is giving. So they will not be competing with them. So that's when talk of non-competing conditions. So those are some of the terms of now there is another one that is dispute resolution and also dismissal from employment. Um, as you know that I remember saying in our last class that where people work together, when people come together, there is likelihood of their having some maybe disputes, and therefore these disputes ought to be resolved well and amicably. So they are in that terms and condition they might outline the disciplinary measures, the grievances, resolutions, maybe procedures, and also they will also talk of how a person can be dismissed from employment or how either party can be a terminate that when we talk of that we refer to the terms and conditions of employment. So that is it with the salaries and wages. Let's now look at the account service and organization. The accounting services in an organization. You remember when we were introducing ourselves to the unit. I remember saying that there are various departments that are there in an organization, and one of the department that we talked of was the finance, or what we refer as the accounting department. For accounting or finance department, this is a department that deals with finances of an organization, money issues dealing with depend on an organization. So, uh, and you know that for any organization, mostly what we call a profit-making organization, the cash must be flowing in the organization. Cash usually flows in an organization. Now, when so this cash also be dealt with a lot of keenness, because I feel of foundation for their own benefits. There are people who usually take properties of the organization. Cash is not being an exemption. They usually take properties and resources of an organization for their own benefit. When that one happens, that one shows that how cash needs to be protected, or how accounting services ought to be done in a prudent manner. So, and when we talk of that, we shall be looking at what we refer to as cash control measures. How can we now control cash or cash flow in an organization to avoid situations whereby cash um, get lost, or the cash cycle is not open. Then is what we call cash control, and it's very important for proper management and monitoring of cash. Without proper cash control, organizations will fall because of, as I've said, um, cash is very liquid, and at times workers may be dishonest when it comes to cash. Therefore, cash must and should be controlled how it flows hands. And these are some of the measures that an organization can have in order to control its cash, or to avoid uh, cash being misappropriated. Number one, we talk of cash transactions should be accounted for properly in order to know the cash flow and the cash balance. Yes, that's why if you go to most of the organization, when you make any payments, they usually issues you with a receipt. A receipt is a record that shows that you have really made some payments. When they receive the payments or when they give you maybe some cash, you'll have to sign somewhere to record that you had been given the cash, so as to ensure that the cash that is flowing into the business is accounted for, or the people responsible know how the cash has moved. The other one is that idle cash should be minimal because additional cash investments earns more revenue. Yes, organizations should avoid having what you call idle cash. This is cash lying in the cash tills, cash in the bank accounts, and others. So organizations should avoid this what we refer to as idle cash, so that to ensure that cash flow on well from one in the an organization, and also this one also it minimizes the risk of fraudulent activities taking place in an organization. When there is no cash in an organization, the chances of people defrauding the organization will be very minimal when it comes to that. The other one is that loss caused due to misappropriation and forgery is to be controlled and stopped. Yes, the organization should ensure that the loss that comes as a result of misappropriation of cash should be controlled or should be controlled, and at the same time it should be stopped so as to ensure that the organization is remains in business. Most of the organizations that have failed, it's because they have failed in this particular area, and that is the area of cash control. If you look at a company that has collapsed, if you look at some of the big companies like Nakumat, if you go into details of why made it to go down, it's because there were no good cash control measures, and as a result, the company failed. So that's when talk it should the company should also should this particular cash control. Another thing is that to ensure that cash is not handled by a single person. Like for example, the person who receives cash should not be the person who issues it out. This is to ensure that there is accountability. The department that receives cash should not be allowed to disperse the same cash. This is to ensure that the cash is kept. The cash control is made a bit open, and also it minimizes the risks of misappropriation. Doesn't talk of that. The other thing is that um, the person who receives cash must not be allowed to record the cash receipts in the accounting record. There should be the person who receives cash, and there are people who records the receipts of cash, or the, the how cash flows in an organization. Why do we ensure that there are as many people engaged in the cash flow cycle, so as to minimize a situation whereby there will be one person who will be controlling the cash flow, and this particular person will be using the cash as per his or her own wish. So that's when you talk of cash control measure. And that brings us to the end of this particular unit. Um, that is it. That is what you are supposed to know about the wages and the accounting services. Anybody with a question? I've now laid the platform to you. Anybody with a question? And I'll start with Machama Valentine. Any question or query, Machama? Nobody Mills.
Pardon?
Yes, me Machama, I can hear you. Chama, yes, Valentine, I'm listening.
Yes.
Yes, any question? Machama. Okay. Robert Millicent.